how the equity method works. Now, so basically FVE, fair value enterprise approach, you're going to use that all the time, except for chapter 4 where you have to know all the other okay. Just want to remind you, I know I've mentioned it before, but on page 3, if you look, page 4, okay, so what's the first step we have to do? No matter what. I don't even know what they're asking yet, but what do we have to do first? Calculate the AD in goodwill and also NCI at acquisition, which is on page 3, okay? So, should I start doing that? Let me just see. Okay, well, let's do this together. And actually, the rest of the question, just so you know, here's acquisition. Oh, that's why this was here. This is just telling you its acquisition date now. I tell you, my brain today. So this, you could leave that title there. That's okay. It's just a title. So this all talks about the acquisition date, which is January year 5. So first thing we have to do is calculate acquisition differential and goodwill and also NCI at action. So why don't you put it on pause and try doing it. We'll come back. You can unpause it and I'll keep going. Okay, so we're looking at the price paid was $27,200. Now, what's our, and that was 80%. Our first line, what did you guys get? What's it called? We're using FVE because we're using it for all the rest. And was there a separate share price given for NCI? No. So we use the implied value of sub. And how do I get that again? 27,200 divided by 0.8, which gives us 34,000. Now, what do we take off? The carrying value of the subs net assets. Subs carrying value net assets. So, we go back to the question, and does it show our net assets? And if we look on page 4, this is the end of year 5 here. So that's not at acquisition, so we don't have the net assets of the sub. What do we have of the sub? We have common shares and retained earnings. Well, just as a reminder, assets minus liabilities, or net assets, equals equity, right? Remember? Assets equals liabilities plus equity. So assets minus liabilities is equity. Okay, so assets minus liabilities gives equity. So if we don't have this, what can we use? We use the two pieces of equity for the sub, which are common shares and... Now we mentioned that in earlier chapters, we just might not have used it a lot. Okay, so don't panic if you don't have the assets, because common shares and retained earnings equals net assets. So we're going to take, we're going to take the subs common shares and the subs retained earnings of 10,000 and 6,000 to give 16,000, and 18,000 is our acquisition differential. Then we take less the fair value differential, or FV minus CV. Now, let's see what happened with that. So it says, inventory of company S had a fair value that was 2,000 greater. So we've got to increase inventory. Everything else was the same, plus there was a patent. So we have to increase patent. There isn't one to start with, so we've got to add it. She didn't see that. Okay. So we need inventory to go up by 2,000 and patent to go up by 12,000. To make inventory go up, it's a debit, so it's positive. To make patent go up, it's also debit, so it's positive. So that gives us 14,000, and 4,000 is good. So by now, you guys, this shouldn't even take any energy because you already know it. Okay, now we also need NCI at acquisition. And if you remember, we take the NCI percentage times the implied value. So that's the 20% times the implied value up here of 34,000 is 6,800. Now, generally we don't, on a statement date, we generally don't do a balance sheet at acquisition. So all that you practiced in chapter 4 and 3, doing it at acquisition, we're never going to do again. But you needed to understand that so you know how to go forward. Okay, so year 5. So this was our first step, and if you look on page 3 at the list of things to do, we did number 1. Okay, so now they're going to tell you 5 what's happened during the year. So they want the consolidated statements at the end of year 5 given the following information. So again, looking on page 1, this at the bottom, we have to do the steps in the middle. Okay. We're not until chapter 6. Yeah, and I think we're good. And I think this is chapter 6. Okay, so 3 and 4 we won't do, but this way you can just follow what we're doing. So during year 5, company S, the sub, reported a net income of $7,300 and paid a cash dividend of $2,500. Now, how much will go to the parent? Not all of it, but 80%. So just 80% times 2,500 gives us 2,000 to the parent. Now, KP, the parent's net income for the year was $20,300 or $18,300, not including income from investment in S. An impairment test on goodwill conducted during year 5 showed a $50 loss had occurred, and also the sub owes the parent $1,000. Okay, so first thing I want to talk about. You kind of have to imagine yourself in a classroom. It's nice because I usually have 2 sides. But imagine sitting in front of you is the parent and the sub. Okay? So, we're doing, with consolidation, we're combining the parent and the sub. Okay? So, one owes the other, and then you combine them. Can they still owe each other if they're one entity? No. Okay? So somehow we have to eliminate this. Okay? So that makes sense. We did stuff kind of like that last chapter. Now, the other thing is that this dividend, just like in the other chapters, can the parent record that as income if they're combined? You can't get income from yourself, right? So we've got to eliminate this. And then to record the goodwill. Okay. Now, because of time moving forward, things change. Okay? So if we had done the balance sheet at acquisition, we would have written that inventory up by 2,000, right? What happens to that sub's inventory during the year? Well, hopefully that inventory gets sold, right? So we will increase it during that first year, but then the next year disappears, so we're going to have to decrease it because it's gone. So if we assume company S uses FIFO, and we will always assume that, it would be safe to assume it was sold. Since the cost of sales of company S doesn't reflect the 2,000 additional costs, then we're going to have to increase cost of goods sold or cost of sales by that 2,000. Okay? So the sub is going to have their own little income statement. They're going to have inventory on it at the beginning of the year, and then they're going to sell it. So remember, inventory when it's sold goes to cost of goods sold. So they have a low amount in this case, and it goes to cost of goods sold. So when we go to combine our statements, what we do, as we did in chapter 4, is we take the parents, I'm going to draw it at the bottom. We take the parents statement and the sub statement and add them together. But you have to eliminate things like now, with respect to this inventory, we've got inventory on here at low at the beginning, and then it went to cost of goods sold. So cost of sold is too small. It doesn't have this nice 2,000 added onto it like we have for consolidated. So we're going to have to increase cost of goods sold. To recognize that we actually know the inventory is worth 2,000 more to with. Okay, the next thing, the patent with a life of 8 years, value 1,000, and we have to amortize it yearly because notice it's got a definite life. So again, that patent is not on the sub-statement. We're pulling off the statements from the parents' books. So that's from parents' books. And this is from subs books. They don't have a patent on there. So there's no patent. So we put them together in the consolidated. We need a high cost of goods sold, and we need a patent. So somehow they have to get added on. Okay? I'm going to say that one more time. This chapter and the next two chapters are the hardest ones for this whole course, because you have to imagine something happening. We're very used to, in accounting, putting stuff on the statements and there it is. Well, now we're dealing with a pretend statement that's merging this together with the NCI to get 100% of both companies. As a result, we have to adjust things that are on here and deal with things like cost of goods sold from there over the year, or amortization on a patent. Add the word patent and amortization. Okay, so I added amortization there. So we're having to imagine, okay, it's not on there, the patent. Oh, now it is, but we also have a year's passed, so we have to do 1 year of amortization. So we're going to have a patent less amortization and the amortization, and we've got to make a high cost of goods sold. So we're doing a lot of pretending and imagining transactions going between. Talk yourself through this. You can say, who doesn't have the patent on their book? Well, it's the subs and the parents. It's nowhere. But somehow it has to